good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is your daily dose of 1 hour of personal finance. Here's what we'll be discussing today on the show. A relook, giving your entire investment portfolio a relook, how your asset allocation should be from equities to debt, and what should your asset allocation be given the fact that we are, of course, in a new world, in a post-pandemic, or rather in the middle of a pandemic, a COVID world. How can debt funds as well be used to diversify your portfolio? All of this will be discussed today on the show. We'll also later on be talking about whether mid and small cap funds may finally see a comeback, and if you have to increase your SIPs, should that be the segment to do that? Not to mention, we'll also be touching upon the big announcement from the RBI yesterday, and that is an opportunity for individuals to restructure or recast their personal loans. Action-packed day right here on The Money Show. But first up, let's bring on board our very first topic of discussion, and this has to do with investing your money in debt and equity mutual funds. Where should you start? And especially for those individuals who may be starting off right now, what would be the right asset allocation given the fact that there's so much uncertainty as well around us because of the COVID pandemic? Plus, we also had the RBI announcement yesterday. So how would it essentially change things for debt funds from here on? Let me welcome on board Mr. D.P. Singh, Chief Business Officer of SBI Mutual Fund, to take this conversation forward. Mr. Singh, really appreciate you joining us today on The Money Show. Many thanks for giving us your time. To start off with, sir, these are times when we are seeing a lot of uncertainty. We don't know what the future looks like. Yesterday we had the RBI governor say that, look, the economy could actually degrow. We could be seeing negative growth in the economy, which then makes you think that, what, should I even be investing in equities? So what should be a good asset allocation strategy? If I have a certain amount of money and I'm saying that, look, I want to invest it because I don't want my money to lie idle. But then I have news coming like this from the RBI governor that maybe, the GDP is under tremendous stress. So how should one allocate their money?
Yeah. There are two parts of your question. First thing first is that whether we should put money in equity at this point of time, and when the growth is going to be negative or growth is going to be very, very less. But you have to understand one thing, that when we are putting money, whenever we put money in equity, we think about future, not about the past. And future looks to be very, very bright as far as India is concerned. When later or sooner, it's a matter of days, we all are very, very optimistic that this pandemic period is not going to end for very, very long. We'll be out of it. And once we are out of it, India is going to be in a different era. And that era, Indian corporate sector is going to do very, very well. And whosoever is allocating money to equities today is definitely going to benefit. Because whatever the negatives are there, those have been factored. And though the kind of rally which we have seen in the recent past is on the basis of this optimism only, that going forward future is very, very bright. That is one part of it. And second, as far as debt funds are concerned, debt funds, yes, debt funds will relatively give always a better return than any fixed coupon instrument, for the simple reason that this is a capital market instrument. And in capital market instruments, you will get the market-related returns, and the tax treatment of any capital market instrument is totally different from a fixed coupon instrument. And there can be so many tax efficiency, tax planning ways and means where you can actually better your returns on your investments and on your savings portion. That's how we have to take it.
Okay, I'm glad you brought up that point of whether debt funds give better returns than other fixed income instruments. We had this interesting point from the RBI that usually when people have to put in money in fixed income, that's basically in an instrument that, will give you this exact amount of, return, like they mentioned, fixed income, they rush towards fixed deposits. Even in April to June quarter, fixed deposits double. So if you could talk to our viewers about how debt funds could be, firstly, give better returns than FDs, and are also a great, tool for diversifying your portfolio.
Yeah. There are two parts of it. One, we are in an era where the interest rates are going to further go down. Even the RBI credit policy, we talked about yesterday, that the accommodating status is there. They're likely to cut rate further. And see, RBI governor was very, very candid about this, that the inflation is high, but inflation is high because of simple reason. One major reason is the petrol pricing not going down, or the taxation on the petrol prices. That's one of kind of thing. And in the coming period, if interest rates further go down, the debt fund will have a good capital gain. If you look at last 1 or 2 years return, 3-year return on debt funds, most of the good debt funds have given a double-digit return, whereas the fixed deposit rates were around 6, 7, 8%. But while saying so, I am not at all suggesting that going forward it is going to be double-digit return. I'm saying relatively post-tax, the debt funds are going to be better instruments. There are two reasons for this. One, there is likely to be, at least in next 12 to 18 months, there's likely to be some capital gains coming in the debt funds, and we are putting money in all the open-ended debt funds. And second part is that you are having a lot of solutions which can be built around it. If you are having some capital loss in, say, any other asset class or equity asset class, you can have some notional loss, and which can be adjusted in the short-term capital gains from the debt instruments. So net, your returns become very, very tax efficient. So you have to look at it that if you have the surplus money has to be in the capital market instruments as much as possible. While saying so, there some portion will always remain in bank deposit. You have to limit it. When you are talking about asset allocation, what part of it? 10%, 20% in bank deposit, remaining has to be in capital market instruments.
Okay, so it's fine to put 10 to 20% odd in, bank deposits, in banks' fixed deposits, but yeah, ensure that fixed income part of your portfolio, the remaining 70 to 80 odd percent is put in debt funds, and you put 10 to 20% in fixed deposits, because yes, like Mr. Singh as well mentioned, there's also that tax efficiency bit that kicks in if you hold your debt funds for more than 3 years, because then you get the benefit of indexation as well, which essentially helps you bring down the cost of match up your cost of funds, and thus reducing your tax liability. Okay, you've also mentioned this concept of SIPs in debt funds. When we think about SIPs, we usually think about doing SIPs in equity mutual funds, but you speak about SIPs in debt funds as well. Now, usually debt funds are used for the shorter term period. For example, maybe a short and medium term fund will be used for 1 year to 3 year time horizons, and long term funds are used for maybe 3 to 5 years. But would you advise a SIP in a debt fund for even maybe a short and medium term debt fund?
Absolutely, I'll do that. If I have a saving surplus of say 25,000 rupees a month, my allocation will be 5,000. Let it go into equity fund. Remaining 20,000, I'll put 10,000 into long-term debt funds and 10,000 into medium-term and short-term debt funds like money market funds and low-duration funds. This money market fund and low-duration funds will work for me as an emergency money, which I can withdraw at any point of time. And generally, the returns are going to be 100 to 150 basis points more than the policy rate. Today, if we are having a policy rate of say 3.35%, on a period of 3 to 6 months, generally these funds are likely to give you 150 basis points more than that. That has been seen in the past. Unless and until you play aggressively in the credit, and that is not the thing which we are doing now, none of the mutual funds are doing, especially in the short duration funds. So then it's almost certain, if your quality of portfolio is good, then these funds are definitely going to give you a good return. And the SIPs in these funds for meeting all your short-term and long-term goals will be met.
Mr. Singh, I want to bring to your, I would like your comment on some common questions we get from our viewers on our email address. And that usually says that, there's so much of uncertainty around debt mutual funds because the fact that corporates are struggling at this juncture to, get cash in their hand and hence to repay their lenders, obviously maybe the corporate bond debt funds as well, or the credit risk funds as well, may find themselves in a little bit of trouble. So, and yes, we are still, like I mentioned, right, we are still in the midst of all of this uncertainty. So, Mr. Singh, is it better for people to invest in, your AAA rated bonds, or high quality bonds, and right now avoid, venturing into maybe AA rated bonds, etc.?
Yeah. See, one thing is there, see, as you rightly said, there has been some trouble in the recent past in debt funds, but that is very, very one-off kind of case. We have a total portfolio of 15 lakh crores as far as debt funds are concerned. And out of 15 lakh crores, if there's a trouble in 2,000 or 3,000 or 5,000 crores, that should not be seen as the thing. And 2,000, 3,000, 5,000 crores, what I'm saying is the fund size. And the trouble could be only 1,000 or 2,000 crores, a maximum. And that too is the time liability, time lag between the getting the payment and making the redemption amount. So keeping that side aside, say yes, AAA rated funds are really, really quite safe. But there are some very high quality AA papers also. There are some AAA rated papers which some fund houses may not be comfortable with. In addition to the credit rating, we also look at the overall condition of the not only the papers but of the group as well. So there are so many ways and means of looking at the papers, and AAA rated papers are considered to be quite safe. And one cannot shy away from the debt funds. Debt funds are going to stay there and going to be very, very big. Even government is committed to deepen the debt market, and they have all the what you call they have the intention to deepen the debt market as much as possible, and all their steps are towards that. One should not be worried about if some accident has happened in some particular portfolio. The AAA rated paper bond funds in any case are good, but if you want to have little higher kick or little higher return, then the good quality AA papers are also quite safe. One should not be too much worried about if the corporate is good, if the financials of the company are good. AA rated papers are not going to go anywhere in the near future.
Okay, all right. Just getting a bit more granular into the different kinds of debt funds. We have banking and PSU funds, which incidentally have done very well in this year. Gilt funds. Firstly, the flows have been excellent in gilt funds, which means more and more investors, want to buy gilt funds. And secondly, I guess it's not for without reason, because gilt funds have given great returns in the last 2 to 3 years, double-digit returns. Even now in 2020, amidst all of this volatility, it has been gilt funds, perhaps because of the fact that they carry zero credit risk. Gilt funds is something excuse me, that do tend to attract a lot of investor attention. Do you think gilt funds are the way to go, that when investors do have to pick among the different varieties of debt funds, gilt funds should definitely be among them?
Yeah, gilt fund should be there, and gilt fund have given very, very good returns. But we have to keep one thing in mind, that these gilt funds have given very good returns in a period when the interest rates on the government securities have come down by almost 150 basis points. And any gilt fund which is having a long duration has got a very good capital gain. It's not only the return on the coupon which we have got on the gilt securities, but there's a capital gain also. Going forward also, scenario is looking good that interest rates will further go down. But the quantum of that interest rate going down is now not as much as it used to be 2 years, 3 years ago. It is limited. So if somebody has got 10%, 11%, 12% kind of return in last 2 years, last 3 years, going forward, one should bring down the expectation to 7 to 8%. Today, if our FD rates are 5.5%, then 7.5% return on gilt funds is quite attractive, which is 40% more than your fixed deposit rate. But your expectations have to be, muted. It cannot be, you should not put money just because last 2 years have been very good, next 2 years will also be very good. It cannot be. Because it will depend on how much interest rates go down. Yes, you can have this kind of returns if the interest rates go down from the current YTMs to 3.5 to 4%, which is highly unlikely in near future, in next 1.5 years. Whether this can go to 4% or not, well, nobody can say that. But whether it can go to 4.5%, yes, it is possible that can happen. And if that happens, the funds will give around 7% kind of return. And see, there's no credit risk, as you rightly said. So that's why gilt fund remain the quite safe portfolio. And coming back to the banking and PSU fund, because these are the debt papers of all public sector banks, very good quality, the private sector banks and high quality NBFCs. So the chances of any default are not there, and the YTMs are generally higher than the Government of India securities. So that puts them into very safe category. Post expenses, YTM minus post expenses plus capital gain are likely to give you again a good return in times to come. That's why both these I mean debt within that category, gilt funds and banking PSU funds are the most popular categories in that class.
Okay. Yeah, well, that definitely is quite a popular category. But remember that when investors have to put their money in mutual funds, they do so with a certain financial goal in their mind that they would like to achieve. Now, this financial goal may be 3 months away, it may be 6 months away, 1 year, 3 years, 5 years away. So, Mr. Singh, which kind of debt funds, and of course equity fund investments is always there for the long term. So along with a mix of equity funds and the different categories of debt funds, what should be the asset allocation for, let's say, 3 time horizons? One that may be 1 year, one could be medium term, 3 to 5 years, and one for the longer term.
Thanks to SEBI categorization of all the debt fund categories, this is very, very clear by the name itself. Anybody who is having up to 3 to 6 months kind of period, so they will put money either in savings bank deposit or they will put in a short-term deposit of a bank. And today in both the categories, if I talk about if I take a reference rate of State Bank of India on savings bank account, it is 2.7%. And the short-term FD is giving you 4.5% return. But compared to that, if you keep your money in money market fund, in any money market fund, money market funds are likely to give you around the same policy rate plus 50 to 100 basis point return. So today, repo rate plus 100 basis points will come to 4.5-5% kind of returns will come in that particular category. And for the short term, and any period for 6 months to 2 years, 3 years, the short term funds are the category where you need to put in money. You can put money there. There you will have some capital gains also. Especially so when we say, when there is a unanimity in the views that it's going to be further interest rates going down scenario, vices toward the interest rate further going down. And any money which is for more than 2 to say 4 years, 5 years, in that category we have medium term funds, we have got dynamic bond funds where the fund manager play with the duration, especially in the government securities only. The moment their opinion and their view moves that yes, interest rates can go down, they can bring down the duration to 1 year. Otherwise, they will keep it 7, 8, 10 years. So that fund category as well as medium term category are going to be best for anybody who is putting money for 2, 3 to 5 years. So these are the categories for debt funds. And any portion which is beyond 5 years, so definitely the major portion should go into the equity funds only. That we always say. That equities over a longer period will definitely give much better returns than any other asset class. So this is very, very clear bucketing. 6 to up to 1 year money market fund, 1 to 3 years short-term funds, 3 year to and onwards your medium-term funds, your dynamic bond funds, and your income funds and debt funds. These are the categories where you want to put in money.
Okay, simple strategy given for almost every time horizon that you may be having that you want to invest your money in. Of course, no doubt that if you're a very long-term investor, then equities is the way to go. Mr. Singh, I want in your opinion as well on these new stamp duties that SEBI that has been put on mutual fund purchases. That's basically your SIPs. How will it essentially impact equity funds, and does it have an impact on debt funds as well?
It has more impact on actually short-term debt funds rather than any other fund. Another fund is just a very, very small portion. On a 1 lakh rupees, you are putting 5 rupees only. So that's not a major amount. If somebody is putting 5 lakh rupees and paying 25 rupees as stamp duty, that's not a major amount. This is more affecting more to the corporate clients for putting hundreds of crores of rupees. They were putting in daily, taking out. That has impacted. If you are putting money for 1 day, then definitely it's a lot of money. 5 basis points is a lot of money. 5 basis point for 1 day is almost 1.5. It's a big amount. So those people who are coming for, basically what has done this stamp duty has done is basically has put a embargo on people who are putting money on 1 or 2 days. If you are putting money for less than 7 days in mutual fund, then it is taking a major portion of your return. If the return itself is 4%, that means you are getting only 0.35% kind of return in a week. And out of that, if this portion goes, then your return comes down to almost 25 basis points. That's a major portion. But for a retail investor, for a HNA investor who's putting money for a longer period, for 2 months, 3 months, 6 months, 1 year, this is hardly any cost. This is not a much cost. But yes, corporate clients as well as corporate treasuries as well as bank treasuries, it is affected in a big way. This has become as a hindrance. But there's one positive side of this also. This is giving a lot of stability to the market. The churning, unnecessary churning, putting it on everyday basis, taking it out on daily basis, those clients are no more there because this has become unattractive for them. For an individual retail investor, HNA investor, ultra HNA investor, or family offices, it is not at all a big cost.
All right. Okay, well, there you have it. That's everything that you need to know about putting your money in mutual funds, how you should go about it, depending also, of course, on your different time horizons. Like we mentioned, for long-term investors, equities should be a very important part of the portfolio. For short-term or smaller term or few days, investors can look at overnight funds. Maybe for 1 to 3 months, liquid funds are a good option. And if you're wondering about what should be the debt component for the longer-term horizon, then medium duration, corporate bond funds, banking and PSU funds are as well good option. And yeah, about the stamp duty bit, it's going to have more of an impact for short-term debt funds, because otherwise, if you're a long-term investor, frankly, the impact of the stamp duty is going to be extremely small because the rate of the stamp duty as well is extremely small. Mr. Singh, on that note, we really appreciate you joining us today on The Money Show. Thank you so much for giving us your time and your valuable advice for all the investors who are listening to you right now.